everyone. This is the week ahead, and my name is Tony Nash. Today, we have Arno Venter, Marko, and Tracy Shuchart talking us through. I know this is an early episode for the week, but there's a July 4th holiday here in the US, so we wanted to push this out as quickly as we could, or as early as we could. Arno's going to talk us through unemployment and different messages we're getting from the market. Albert's going to talk us through the US political environment and will Biden run? And then Tracy's going to talk us through some crude oil flows and some things that may impact the market, as well as maybe a few things on this Hurricane Beryl that may be hitting the Gulf Coast over the weekend. So Arno, thank you for joining us. I think the last time you were with us, you were in South Africa. You're now based in Melbourne.
Yeah.
Yeah. How long have you been there?
About 6 months now.
Oh, good. Okay. So I'm sorry it's been that long since you've been on, but that's good. Melbourne's one of my favorite places. It's really great to have you back on. So I'd like to talk about unemployment. You said you're starting to pay attention to the Fed's second mandate, which is great. I mean, people have kind of not even had to look at that since COVID, because labor markets have been so tight. Now, if you look at the May unemployment data, the unemployment rate is right around 4%. And so that is better than what we had in the November 2016 election, which was 4.7% in November of 16. That's kind of the last normal election cycle we had, because it was pre-pandemic. So, to me, things in the unemployment realm don't look too bad. And this week we also got the JOLTS data. Openings remain higher than pre-pandemic levels, which is really interesting for me. And we're seeing the share of government jobs growing. So the chart on the screen, that's the line at the very bottom. But we don't see a spike in layoffs. I mean, I know we see layoff announcements pretty regularly on social media, but we're not seeing a huge spike in layoffs like we saw in, say, 2020. So I'm just curious, kind of what about unemployment has you thinking about this and thinking that things are a little bit more sensitive there?
Sure. I think, something like you mentioned, rightly said, I think for the last, what's it been, 3 years now, I don't think the markets or the Fed really had to worry about the labor market. That part of the mandate was kind of just forgotten. It was all about laser focus on inflation, and I mean, rightly so. But in the last, I would say 2.5 weeks or so, if you take a look at the Fed communication, we've seen a real a noticeable shift towards the labor market in recent weeks. We've heard Powell talk about it, sounding a little bit more concerned. We've had the likes of Daly coming out, Cook, we had Goldsby as well. All of them starting to shift their attention more towards that second part of the mandate. Now, even though I agree that a lot of the absolute numbers are actually still showing a lot of strength, I think there's two areas of focus where I'm looking at right now. The first one would be, I think, what they are looking at in terms of the labor market, which is more the rate of change that we've seen, showing a clear trend of deceleration. So what I'll do is I'll share a table that I look at normally, tracking things like inflation and the labor market. And when you take a look at the labor market as a whole, even though we are still at very solid levels, we are, like Daly rightly mentioned, looking at a possible inflection point now for the labor market, where it's starting to, it's been decelerating for a while, but it's starting to pick up real pace now over the course of the last, let's just say, 2 or 3 or so months. So I think that's what the Fed is noticing, why they're saying that there's a few warning signs in the labor market right now that they're watching. And the other thing that I'm watching here is the fact that the Fed hasn't provided themselves with any wiggle room when it comes to the labor market. Because what we had Powell say at the June presser, and what he said yesterday or 2 days ago was interesting as well. In June, he said that if they see the unemployment rate inching up higher than their forecast, they would view that as what they call unexpected weakening of the labor market, right? And he also said, I think on Tuesday, saying that if they see troubling weakening in the labor market, that's something that they would consider to actually respond to. Now, we need to keep in mind, if we take a look at their summary of economic projections going back for June, they didn't give themselves any wiggle room. They see the unemployment rate at 4% by year end, and they see the unemployment rate at 4.2 by the end of next year. So we are currently sitting at 4% for the unemployment rate. So there's absolutely no wiggle room for them, and they've deemed themselves, or they said that, listen, if we see it above our forecast, i.e. basically just above where we are now, that's going to be enough for them to see that as unexpected weakening, and that could potentially kick in some actions from them. So I think even before yesterday's ISM services, well, for me yesterday, for you guys today's ISM services print that we had, that was a pretty ugly number. Now, it can be noisy, so I wouldn't put everything down to just, look at the ISM. But I think if you look at a composite measure of the ISM employment for both manufacturing as well as services, weighted slightly more towards the services side, that is suggesting that jobs, should have been taking a bit of a knock, a faster one at least over the next few previous months of the previous few months that we've had. So I think going forward, that's going to be a real big focus point for them. And that's why I say that right now, even though the Fed is comfortable that they see only one cut and the market's comfortable for two, I think there is real risk that we might be seeing three, maybe seeing a little bit more than what markets have priced in, purely if the labor market starts to slow, because they've basically not given themselves any wiggle room with what their projections say. And of
You're
course,
saying three this year, this calendar year?
I think so. I think if we see, think about it this way, we need two really bad job sprints. Mm-hmm. And then we are already where they would deem themselves to have unexpected weakening of the labor market. And the other thing that we need to consider, is that it is an election year. Mm-hmm. And, it's not like the Fed is ever, politically driven or motivated by anything, so that's probably not something we need to worry about. But that's also something in the background that I think, could spur them on to maybe act a little bit faster. Mm. But those are the main things that I'm watching right now. I think the rate of change is showing a real deceleration, at least faster than what we've seen in previous months, showing a bit of an inflection. Mm. And the Fed hasn't really allowed themselves much wiggle room there in terms of, think about it from a public point of view, right? If you're saying that 4% is what you think we're going to reach, and now you're saying that if we get above that, we would need to act, that they've basically set themselves up to need to do something. Even if it's just, ramp up guidance, maybe they can talk it away, but, they'll really have to show us something, at least based on the recent communication.
Okay, so what I'm hearing is this, with 400 PhD level economists at the Fed, they have a flat unemployment rate for the next, well, at least through the end of this calendar year, right? Yeah. And it sounds to me that you're really looking at the ISM and those types of indicators to conclude that unemployment should be growing faster than it is.
Yeah.
Okay. And where do you see that coming, that unemployment? Do you see that coming in like service industry jobs, like hotels and travel, that sort of thing?
That's actually one of the sectors that kept up okay. If it wasn't for hospitality and leisure, I think we would have had a slightly worse faring number over the course of the last, let's just say, two prints or so. So I think if there's any section of the services economy that can keep things chugging along, it might be that. But I do think services is where the biggest surprise will come from over the course of the next, let's just say, 2 or 3 months or so. That's basically been the only thing that hasn't been lagging, basically. It's always been up there. So I think if that starts to roll over, then I think we're going to start seeing a little bit more pressure.
Interesting. Okay. Albert, what are you seeing on unemployment and jobs? Are you are you seeing anything in the data that really causes you to kind of worry about this? And I say that with a broader context of, I've seen a lot of analysts echo what Arno's saying, that we need to start being more sensitive to unemployment. I'm just not sure what kind of that ringing indicator is for us to go, oh gosh, we really, really need to pay attention to this.
Well, the problem is they're using illegal immigrants in the workforce and government jobs as, they're using it in the data to manipulate it to make it look like the job market is healthy, which it isn't. Certainly, it's not. Going back to going to the rate cuts, I can see
Hold on, before we get to the rate cuts, I just want to talk through how they would use the illegal immigrant numbers to goose the unemployment numbers. And I just want to talk through this and tell me if I'm wrong here. You have more people working, but they're not formally counted as a part of the working population. So the denominator stays the same, right?
That's correct.
So the numerator is growing in terms of the jobs, and the denominator stays the same because they're not included formally as a part of the calculation. So that unemployment rate looks artificially low, at least according to kind of the actual working age population in the US. Is that how it's done?
That's pretty much how it's done. That's that's exactly right.
And there's been 11 million people or something that have come in over the past 3 years.
Who the hell knows?
Does anybody know? Okay.
Who knows? I mean, official numbers vary. The Border Patrol say one thing and the government says the other, but it's certainly in the millions.
Okay.
Right. It's sizable. But yeah, I mean, job losses is a political football, especially, right in front of an election. There's no doubt about that. Now, when it comes to terms of rate cuts, I could see them doing one in September, but they're having a really hard time of justifying it because as they're keeping the job market somewhat stable and giving out these ridiculous GDP numbers and whatnot, they're making it, the political side likes it for the election, but then the Fed doesn't really, it makes it really difficult to justify a rate cut. Right?
They're actually doing a good job. If you're looking at the data, they're actually doing a really good job managing the economy. Whether you believe the data or can poke holes in the data, that's that's a different discussion. But if you look at the headline data, they actually look like they're managing the economy pretty well.
Yeah, that's exactly right. And that's what they intend to do, is make it look like they're managing the economy pretty well. The problem is that cuts off support for rate cuts, right? Do I think they're going to do one? Yeah, I probably think they're going to probably do one in September. But, as you cut rates, you start setting off inflation. So, it's a double-edged sword. So one, I could see them doing, even two, I could see them doing, but when you start going over 2 or 3, it's like you're playing with fire at that point, because you could send gold, commodities, and everything else, through the roof.
Yeah. I want to go back to jobs for a minute, because as we talk about these immigrant workers in the US, who do they displace? So those are largely services and, say, construction jobs and those sorts of things, right?
Yeah, I mean, I just, we'll be blunt about it. The same thing that Donald Trump said. They're taking, African American jobs, other Latino jobs, and the blue collar Americans, white, middle America, Rust Belt jobs are starting to take away, and it's problematic going forward.
And so is that a factor? I mean, this sounds like a stupid question, but it's a sincere question. Is that a factor in the election in terms, like, do people put those things together?
Of course.
Okay.
Of course they do, especially when, your family has just lost their job. The head of the household lost his blue collar job. Of course there's going to be something that gets noticed, especially in towns like in Iowa. I think Tyson's Chicken shut down a factory, fired everybody, and then went to New York and put out a job fair to hire another 1,000 workers for all these immigrants, because they know they can get them for, a fourth less, third less.
Okay. Arno, how much does that factor into your calculation on unemployment and just a general jobs environment in the US?
To be honest, that's probably one of the Pandora's boxes, if you want to put it that way, from a data point of view, because we just don't know. It's like we can try and look at guesstimate numbers, but even then, it's difficult to assess, you know, like Albert said, when is it a job lost and a job gain, but a real job loss and a real job gain. It makes it very, very difficult. So the only way that I really go about that is just, it's probably not the best way of looking at it, but just taking it at face value. At the end of the day, that's the only thing that we can do with the data, right?
Yeah, you have to take it at face value. I mean, perception is reality, right? You can't trade on what you think is the truth. You got to trade on what you see in the data.
Yep.
Exactly.
We may not like the data, but it's the data we've got, right?
Yeah.
Yeah, but you know, let's not to mention the revisions, which has been like my 1-2 this entire time. But you know, it doesn't matter. Markets don't trade on revisions; they trade on the data.
Yep.
Yeah.
That's absolutely right. I mean, I talk about revisions a lot, but by the time data are revised, the trade's already made. Everyone's already worked it in. So, it doesn't really matter that much. So, Arno, I also want to talk a little more broadly about markets generally. So just a few weeks ago, we'd get a majority of strategists who were unquestionably bullish. No, there's no question whatsoever. If you were a bear at all, or even if you questioned the bullish case, you were kind of ostracized. And now we're getting a few who are growing a bit less confident in markets. So there seems to be some different messaging and some disarray in markets. RCI Markets forecast, which I'll put on the screen, is now showing a slight dip in equities starting, say, later in July and going potentially until October. And then after the election, we see things rise again for a short time. So what is it in markets? Are you seeing some mixed messages? Is this thing kind of really late stage? And are you starting to have some second thoughts about where markets are headed?
I think generally speaking, I think especially if you look at it from before we get there, I mean, I think generally speaking, I think a bullish bias, US specific, talking about the US specifically, still makes the most sense in this environment. As strategists, we don't really want to admit when we look at the markets and we think, I just don't see the next short-term play right now. But that's exactly where we are. I think right now the waters are very, very muddy. I would say at least in the last 2.5 weeks or so, we've had, like you rightly mentioned, we've had a couple of months now where the path was pretty clear, right? The path of least resistance remained pretty bullish on the risk side. Over the last 2 weeks, 2.5 weeks, I think politics, really shifted some things around. I mean, obviously what's happening in France, we've got the UK coming up a little bit later today, but that's not, I think, going to be a big surprise for the markets. But certainly what's happening in France got the market's attention. And obviously last week's debate, got things moving in line with the election concerns as well, because the markets have kind of been, and rightly so, we haven't really been focused on that. It's still in the back of our minds, it's always coming up, but you don't have to worry about that until, maybe September. But I think what the debate done is just brought a lot of those questions forward. So the question now is, okay, if I want to put on a trade, let's say I'm looking at a short-term play over the next month or 2 or 3, how does things that happen over the last 2 weeks, how does that influence my decision-making for those plays? And that's really where it's really a challenge for me right now. I think a lot of the plays that's been playing out should still play out, but the question mark now is, from a relative value point of view, is there still as much potential that we saw maybe just 2 weeks ago? And for me, I just don't know what that answer is. I think something that will potentially shift me a lot more bearish is if we start seeing growth really, really collapse to the downside. Right now, that's not my base case, but I think the worst case scenario for this market right now would be growth taking a big knock. So if we see more data points like services PMI yesterday, we see maybe 2 or 3 more of those types of prints, especially looking more towards the hard data. Because what's interesting is that over the course of the last, let's say, 18 months or so, we've had that weird divergence between the soft data and the hard data, where the soft data was, last year it was terrible, but the hard data kept on chugging along. Now it's been slightly different. We've actually had the soft data before yesterday, at least. The soft data, keeping up okay, showing some improvement, but the hard data has been consistently pushing lower. So if you take a look at GDP and retail sales, if you take a look at all those things, even though there might be some influence involved in some of those numbers. They've kept up pretty, they've been showing us some signs of deceleration, while your soft data has kept up okay. But I think if that starts to change and it really decelerates, that's probably going to be something worth thinking about or worrying about, especially if at the same time we start seeing things like inflation push back to the upside. Even if it's just a short-term acceleration, the markets won't like a stagflation environment ever, whether it's going to be a month-long affair or a quarter-long affair. So I think that's probably something that gets me a little bit more concerned. But having said that, I think when it comes to risk specifically right now, I just don't see any other game in town as apart from the US, right? Let's just assume that we do get a knock in growth and we do see inflation as a problem. Where else, I know a lot of folks who would love to get a lot of their money outside of their local countries and into the US markets, even if it's just from a liquidity point of view. But it's so difficult for people outside the US to get more money inside the US, at least out of their locals and into international markets. If it wasn't for that, I think US markets would be even stronger, because at the end of the day, I just don't see any real good alternatives. So the challenge where you have is that, okay, even if you think there might be a little bit of a hiccup ahead, I just don't see any other viable alternatives that would make sense, from a positioning point of view. So
Yeah.
I
When
think,
you mentioned collapse in growth, that's a relative, that all of this is relative, right? And so,
yeah,
given what's happening in China, given what's happening in Europe, other places, it would actually have to be pretty bad for the US on a relative basis to not receive more investment. Is that right?
I think so. I mean, it would need to be, even if you look at, everybody's getting excited about places like Europe, but it's really a case of not having negative growth to now having just flat growth. It's never sexy when you look at it outside the US, right? It's like it's either going to be between recession or not recession, but it's never going to be fantastic in terms of growth. So I think even if we see a real big punch coming up for growth in the US, it might still be able to hold up. Now, there's obviously going to be a lot of relative value plays kicking in if that happens. We're going to have more value outside, but we all know that those types of plays are, you may be going to run that for maybe.
Well, yeah, you can invest in the Nikkei, but you've got to take JPY risk, right? I mean, that type of thing. So
there's always going to be a trade-off. So at this stage, I think
it would be it's the same currency risk if you're in South Korea, right?
Yep.
Yeah.
Exactly.
Yeah.
Exactly.
Yeah, but the only issue is like, the US right now is 71% of the entire global market share if you take out the A shares in China, which are uninvestable at this point. I mean, how much more can the US market really be of the whole world? 76%, 80%? I mean, those are just staggering numbers. I mean, there's got to be some kind of line. There's got to be a line in the sand somewhere where, you start taking the world starts taking chances. I'm not saying Europe is it, because you're absolutely not. Europe's not it. Europe is just a vacation spot right now for the rest of the world.
What's interesting about that, Albert, is the market is not the economy, but there sure is some weird disparity in that, right? When you look at how much of market value is the US versus, say, China, which is supposedly the second largest economy, but they just pale in comparison to the US.
Well, yeah, me and my client did the numbers, and it was staggering that if you took away the A shares in China, it's 71% of the entire world right now, the US market.
That's crazy.
Mm-hmm.
Wow. So Arno, where do we go from here? Like, what are you thinking about in terms of your strategies in the short term? Are you looking at, say, the 10-year? Like, what are the kind of items that you're looking at to help you see through where things are going to be in the next, say, 1 to 2 months?
Some markets have been really, really tough. I think the commodities have been a real tough call on my side. Commodities have been, some of those markets haven't, at least in my opinion, I mean, Tracy will know better, but some of those markets, in my opinion, haven't really been moving like you would expect them to from a pure, fundamental point of view, if you want to put it that way. I think there might be some other forces in play for those specific types of markets, but In terms of strategy short term, I mean, my main focus always comes back to more foreign exchange. That's really where it's either that or equities right now for me. In terms of the bond market, I'm a bit more cautious there, because inflation, even though if you look at the data, we don't have reason to be super concerned, at least, let's say over a quarterly basis. We are seeing commodities rip once again across the board. So if those things are allowed to continue with their trend, then that places some potential risk on the inflation side, which makes bonds, if you're expecting the economy to slow, you would like bonds to the upside. But the only thing that's really keeping me away there from a short-term play is just what could potentially happen from a short-term point of view with inflation, if you look at things like commodity markets. So I think it's either going to be between equities and FX from a short-term play. And there I would prefer to actually just go with the FX space right now, because there we've seen some actually real solid differential plays over the course of the last few months. It's been really a case of, okay, if we're assuming everybody's going to cut rates, is there somebody that we think is going to cut a little bit less, maybe a little bit slower than the rest? That's really been the play.
Who is it? Who's going to cut slower?
Look, right now there's only two. It's the RBA and it's the RBNZ. I'm not counting the Bank of Japan, because everybody's expecting them to hike rates. But I
in like 2045.
Yeah, when it comes to the BOJ, it's something that it's a clown show. It's a complete clown show at this stage in terms of their communication. But I mean, right now, the more interesting relative plays is the RBA and the RBNZ. At least it has been over the last few weeks. The other one that I think is interesting, but not necessarily from a medium-term point of view, again, short-term, is that some of these banks have now cut rates, like the BOC. They've cut rates, and there is a lot more stress from a housing market point of view. And if you take a look at there's a lot of people that I talk to in Canada, and they're saying that, if you look at the recent data, it seems like everything is okay, but there is some stress, it seems, at the ground level. A lot of people saying that they are postponing holidays, not really having confidence in the economy to do those types of things. So those are a little bit of warning lights. But anyway, having said that, they literally cut rates. They said more rate cuts are coming, and now we've seen inflation reaccelerate by quite a punchy rate of change measure in Canada. Growth has actually come in okay. Commodity markets are ripping. So it's going to be interesting for some of these markets where they've cut rates. The market's expecting to cut more, but there's a chance that maybe they don't. Maybe the data doesn't allow them to follow through with that, and we just see them staying at a slightly lower for longer level, if that makes sense. So that's what I think could be interesting. Some plays like the BOC, but for now, I think that's really where I'm focusing most of my attention. I think that's the easier play right now. It's just looking at those differentials from an FX point of view.
So the periphery of the Anglosphere, as Albert would say.
Yeah, I mean, listen, this tells me that this is the Fed testing the waters across the Anglosphere central banks. They're telling them, cut rates, see what happens, and they're just collecting the data to see how they can offset it when they want to cut rates. In terms of the FX play, I agree. I think FX right now is probably the best thing if you want to, test your luck on it. At some point, the yen becomes very attractive. At 170, 168. I mean, you got to take a chance at that.
Yeah, but are we near that? I mean, we're a few months away from that at least, right?
I don't know, man. We just went up 2 basis points in like 3 days. So who knows how far? Yeah, even 2 months away though. I mean, at 168, I'm gonna try my luck at the end. I'm just telling you flat out right now.
Interesting. Arno, what do you think about that? Do you do much in Japan?
I back in 2022, yes. Over the last, I would say, year or so, I've been trying to avoid the yen as much as possible. From a carry trade point of view, it makes a lot of sense, right? Carry is super sexy at these levels still. But the problem that I have is that your risk to reward for trying to, earn the carry with the risk of being knocked down, maybe 5 or 6 big figures every now and again. For me, it's just not an attractive play right now. I think if you caught the move back in 22 and you've been riding the carry ever since, then you probably don't even worry about it, which I think is the case for most of those that's been that's been short the end for such a long time.
Yep.
But from a short-term play point of view, it's just so messy. You know, like Albert said, if you get to levels that are just eye-watering, then maybe there's a chance of taking a stab at it. But in the short term, I've been trying to avoid it like the plague, to be honest. I don't.
Oh no, you're absolutely right about avoiding it. I mean, this is I've maintained that this is Yellen's doing of driving the yen up, and I think she wants it at 170, and I wouldn't touch it until that level. I just wouldn't. Short term, you've seen what's happened. They were defending 150 and they got blown apart, and now they're at 162, and it doesn't look like it's going to stop. But at some point they got to step in, otherwise things get pretty nasty.
Tracy, what do you think about what Arno's saying about commodities? Do you think they remain strong, at least in the near term? You're on mute. Sorry, you're on mute.
You're on mute, Tracy.
All right. I know, I got it. I'm on mute. Sorry. I'm still commodities bull, but you have to understand when you're investing in the commodities markets, these markets are highly volatile.
Yep.
So you either need to resolve to be trading them, which means you're in and out of them very quickly, or you're going to hold and just clench your butt cheeks and go on with that. And, when 2020 happened, in August, I started buying a lot of oil and gas companies, and everything hit rock bottom, and it went, it was a horrible trade. Nobody wanted to get into it. Nobody would, and it was very volatile, and it was where, but 5 years later.
Looks genius.
Yeah.
Right. So, you have to be very, I would say if you're a commodities investor or entering into this market as a new commodities investor, you have to be very aware of what this market does and how this market trades, because it's very volatile. It just is. And so you either have to be an active trader in it, or you just have to hold on and hope your thesis is correct in the end.
Yep. That's wise words. Very wise words. Okay, let's move on to the political story of the week. Albert and I, just for everyone's information, Albert and I just recorded a video earlier today for Cloak and Dagger. It's free for everyone to watch. We went into the deep detail of the Biden issues and the campaign issues and everything else. But we're going to talk about that a little bit here as well. You put a piece out on Cloak and Dagger, Albert, right after the debate, kind of saying this is what you need to think now. And as we watch all of this stuff happen with Biden, with the Democrats, with Trump, with, someone was telling me yesterday, it almost feels like it's a movie plot. It doesn't feel like it's real, because all these things just seem so weird to happen this late in an election cycle. So I've got from yesterday, the RCP average showing a, clear divergence between Trump and Biden since last week. I guess my real question is, can Biden not run? That's my first question. Can he not run?
He cannot run, right? There's absolutely he cannot run. He can just throw up his hands and say, I'm done, the hell with all this. Can the Democrats afford him not to run? No. Right? There's, anywhere between 80 and $200 million in the Biden camp that can't be just simply shifted to another candidate. That's why I think they came out today. So someone was saying that Kamala Harris on the top of the ticket would allow them to keep that. Again, that's just nonsense, because if you look at the polling for Kamala Harris, it's so atrocious that you can't really expect them to go that way, right? Gavin Newsom is another potential name being thrown out there. He's not in the right side of Obama, so I don't think he has a chance to take the ticket. On top of that, his polling is awful. At this point late in the game, with a month, 2 months until early voting starts, I don't see how they could even think they can't get rid of Biden. It's becoming quite clear when you're looking at the polling, you're looking at the swing states, that they need to carry. That is just not an option right now. So they're going to have to pump him full of drugs and put him back out there on the campaign.
You think because I've heard the same things about Harris today as well. You think that's not a viable approach. Now, is it a viable approach for them to kind of keep the money? Because
Yeah,
there's
of
hundreds of
course.
millions of dollars there. So if it was Harris Biden instead of Biden Harris, there are some issues. The money. Could they keep the money if it was Harris Biden instead of Biden?
Yes,
Harris?
that's
Okay.
yes, they could.
And then another issue is having the nominee's name on the ballot in different states. If it was Harris Biden instead of Biden Harris, would that still be viable for those states where they can't change the name?
If it was Harris Biden, they can keep it like that. If it was Harris somebody else, then no, they can't. And they'd have to do a write-in ticket, and then that gets all messy.
Very
It's just
confusing.
it's a very confusing thing. The last thing you want to do is confuse voters that barely understand anything to begin with.
Okay, so your baseline scenario is that they're going to keep Biden, they're going to keep the Biden-Harris ticket. That's your baseline scenario.
Yeah, they're gonna have to. They have no other choice.
Okay. Let me look at the other side. What is Trump's biggest risk right now?
Trump's biggest risk is really himself. I mean, the court cases that are still, that sentencing that got pushed to September 11th or 14th or whatever it is. That's the biggest risk, is them putting him being put in jail or probation or something along those lines where he can't go out and campaign. I mean, I think it would blow up in the Democrats' face, but still, it doesn't help Trump at all. Or if he picks a bad vice president, that could also shed a few points.
So tell me what would be, and you can name names here, but what would be a bad VP pick for Trump?
I think JD Vance would be a bad pick. I think that guy is just a blowhard. I don't really care what any people say. I mean, I'm a Republican. I just don't really like the guy all that much.
He's not all that likable. It's hard.
No, he's not really. He's kind of a jerk and whatever, I mean, picking someone like Marko Rubio doesn't really help you anywhere, and he's kind of like, I don't know, kind of a stick. Yeah, a little Marko and whatever.
They're all kind of men.
Yeah, I think if I had to choose someone right now that Trump is really considering, is probably Stefanik over in the female Stefanik over in I think she's from New York.
You can't pick Noam anymore because she killed puppies or something, right?
Yeah, well, yeah, that, and she also has she had some kind of rumor about extramarital affairs and whatnot. Rural voters don't usually like that, and I think I still like John James. If Trump wants to win, he needs to pick John James and take Michigan.
Yep. Yeah, I think that's solid. You've said that for months, and I think that's pretty solid. So, okay, so I also hear, whenever there's weak leadership in the US, I hear people say, oh, Russia's going to take advantage of this, or China's going to take advantage of this, or something like that. Is that something people should worry about?
I mean, we've had weak leadership for 3.5 years. I mean, they've taken advantage of us every which way. I mean, they've taken geopolitical advantage against us. Lover or hater, Yellen's actually did well combating China and keeping Russia's finances in check. But aside from her, there's no leadership. Anthony Blinken is just a waste of space and needs to leave. I mean, you look at all the geopolitical errors that we've had, they're basically self-inflicted, but the Chinese and the Russians still take advantage of it, and they've made great inroads into Africa and South America while we've been asleep at the wheel. They for sure have taken advantage. Have they taken advantage as much as they could? Probably not, because of economics. But that's just the way it is. Yeah.
So I guess more to the point is, does this discrete event of Biden flubbing the debate and the Democrats look weak? Is that an opportunity? Do you think they'll capitalize on that specific opportunity to do something? And the thing that always comes up is, oh, they're going to invade Taiwan. Like, people are so excited about China invading Taiwan.
Yeah, I know. And they get all orgasmic when they talk about Taiwan. No, I don't think so. It's too close to the U.S. election. The last thing that anybody wants to do is get on the bad side of the U.S. government, because they don't know who's going to win, right? Yeah. They don't know. And if Biden stays in and he wins, and then there'll be retribution to be paid. And that's the last thing anybody wants at the moment, whether they're the Europeans or Asians or Russians or whoever. Yep.
move into a crude, Tracy. It's great to have you back. I know you've been super busy for the past couple of weeks, so it's really good to have you back on. Thank you so much for coming on. So you discussed a few things this week that caught my interest. One is Venezuela. The U.S. is resuming talks to re-legitimize Maduro, which seems kind of weird. And so that we can ultimately buy more crude from Venezuela, I guess. So we've talked about this before, but I just want to cover it again since Venezuela is in the headlines a little bit. Why, like, what can the U.S. get out of Venezuela? Is there spare capacity that the U.S. can get out of Venezuela?
There's nothing really out of Venezuela right now, except for a political push-pull. Because at the same time, we saw Maduro saying, we're going to have talks with the Americans on renewing, talks on sanctions. We also had Russian warship pull up into their port. And so what I think it is, it's kind of right now, I think it's a push-pull on kind of a diplomatic relations. It has nothing to do with oil at this point. I think it's who has more push-pull in this country at this time, politically speaking, rather than anything having to do with oil. I mean, the country, there's so much you have to pour into this country infrastructure-wise to get any more drops of oil out of this country, and we know very well that, you have Hezbollah there, you have the Iranians there, you have Russia there, you have the US there. And so I think right now this is more a political stance more anything, especially when you see Venezuela kind of rearing their ugly heads at Guyana, which would put US E&P producers in that area in danger. And so really, I think this is all political, kind of a political play.
So it's more regional influence than, say, energy related.
Correct.
Okay. And most of their energy goes to China, right?
Anyway, yes.
Hang back.
And Cuba, actually, Cuba's the largest.
Okay, good to know. Now, there's also, you pointed out export decreases from several oil exporting countries, including Saudi Arabia, Iraq, Iran, and so on. Are these unplanned? And how much of an impact does that have on supply and prices overall?
Well, I think, a lot of this has to do with how and in the Middle East, as far as, exports are concerned, just because of the entire consumption of millions of people descending in this area for this religious event. But, in general, I like to stress that I think that OPEC Plus, no matter what anybody says, it's still a very cohesive group. And yes, you're going to see some oil producers kind of step outside the line, but overall, I think Saudi Arabia has done a very good job of kind of keeping all of these people in line, because let's be fair, this is actually who runs that group.
Yeah, it's not an easy group to manage, and they've done a pretty good job. One last thing, there's this hurricane that's brewing in the Gulf, Beryl, and the early forecasts on it showed it kind of going straight into Mexico. But the more it develops, the more they're saying it may hit Texas and the Gulf Coast. So, it's early in hurricane season. It appears to be a pretty strong hurricane. But as you, as an energy analyst, head into the hurricane season every year, what do you think about when a hurricane is approaching?
Well, you always have to look at, first of all, is it going into the Gulf? Is that going to put offshore production offline? Then, if it hits onshore, does it hit Louisiana? Does it hit Texas? Does it hit Mississippi? Does it hit areas where we have a lot of refining capacity going on? And not to say, if it hits if it hits Florida, that's just as horrible. We're just talking as an energy analyst. You have to look at, is this putting production offline? And or is this putting refining capacity offline? And or how much is this going to devastate a certain state that it hits, as far as, does this take supply offline because you can't drive anywhere, because you can't, everything is shut down. And so there's a lot of factors to be involved when you're looking at the hurricane season. Of course, we got a little uptick on this. There's no indication that this is going to hit directly at the US, we never know.
Right.
But we did see, you know, oil earlier spike this week on fears that, you know, it's an early hurricane season. Nobody likes to see that.
Yep.
What does this mean for the rest of the season? So, but for now, it's kind of a hurry up and wait and see, you know.
Right.
And, you know, be prepared, everybody.
Right. And so when let's say if it did hit the Gulf Coast in Texas or Louisiana and some refineries had to close down, how long does it take them to close down a refinery? And then how long does it take them to restart a refinery?
It takes you about 2 seconds to close down a refinery. It takes you about a month to get it back up.
Really? Okay. So
Realistically speaking, depending on what's hit, you know,
fully
like,
back up and
you
running.
know what yeah, but if
Okay.
you want to if something is hit, really you're done immediately. Generally speaking, if a refinery is put down, you know, it takes, depending on what part of that refinery is hit, you know, it's going to take you at least 2 to 4 to sometimes 6 weeks to get that refinery back up and running, depending on, you know, what has been affected, how much flooding is concerned, you know, what part of that refinery is hit. I mean, there's a whole lot of things involved in what could happen to a refinery in the midst of a hurricane.
That's all good to know. And how much of US refining capacity is in kind of that Texas, Louisiana area?
Most of the US refining capacity is
there. Okay.
to be honest with you. I mean,
Okay.
not all of it, but I would say you have a good 2/3 of refining capacity right in Hurricane Alley.
So I just want to be clear, our coastlines in Texas are cluttered with refineries, whereas the Florida coastline is pristine and beautiful, right?
But we're full right now.
We got red tide. It's
We
poison.
should- We've got
Come here.
sharks.
Go to
we got
Melbourne. Go to
sharks.
Melbourne.
Go to Melbourne. Should go to Melbourne. I heard Melbourne's great.
Beautiful place.
Beautiful, stunning.
They got kangaroos and stuff.
Yeah, all sorts of stuff. Tasmanian devils, or that's in Tasmania.
Tasmania.
Whatever.
Okay, guys, thank you so much. Arno, really appreciate your time. Really glad you could join us. And thanks for meeting us at 7 a.m. Australia time. That was fantastic. So really appreciate your time. Have a great, for you guys in the US, have a great long weekend. And Arno, have a great Thursday. Thanks a lot, guys. Thanks. Bye.
Cheers,
Thank you.
everyone. Thank you.